Counties, the Finance Corporation, and with him is Terrence Murphy, who is the program manager for California First Program, with which is a joint powers authority of which Colliers County is one of the counties partaking in that JPA. And I'm sorry, I don't know the gentleman who's also joined us.
Sure, my name is Simone Bryce, and I'm with Renewable Fund, one of the program team partners.
Great, thank you, welcome. I'm going to turn it over to Tom or Terrence, and we'll find out more about it.
I'll just lead off with just a couple of opening comments. One of the things that the Finance Corporation does for all counties and cities and federal districts is we are able to bring the economies of scale to lots of projects, and this is a prime example to where you can take advantage of using a program that would include up to 400 or 500 jurisdictions statewide, and use the economies of scale, save money for the county, save money for the citizens within the county, which is really our purpose. We are piloting this particular program dealing with renewable energy, not just solar, but solar is pretty much what we're looking at the moment. This gives us an opportunity to kick the tires, make sure it works before we roll it out completely, so that a lot of the kinds of tinkering that we need to do, we're able to do ahead of time and take advantage of the legislation that allows us. I'm going to turn this over to Terrence Murphy and let him go through the particular project. And if you could please hold the questions until he's finished, and then we can get into a further discussion. With that, I'll turn it over to Terrence.
Thank you, Tom. Good morning. As Tom indicated, I'm Terrence Murphy with California Communities. We're a joint powers authority that the county and every other county in the state is a member to. We have over 500 members at this point. And today I'm just going to talk to you a little bit about California First, which is the program we're developing based upon AB 811 and also somewhat on AB 474, which added the ability to finance water efficiency measures into a similar structure as AB 811. So just briefly, the outline, I'll talk a little bit about the challenges surrounding solar and energy efficiency, as well as our particular solution, which is California First. And I'll get into a bit about the process that counties and cities will need to participate in terms to join the program, as well as what the property owners or businesses will need to do when the program is available to them. So the challenge, AB 32, which is the CO2 reduction legislation, requires approximately a 30% reduction in the CO2 usage by existing homes and businesses in California, which means there's approximately 13 million pieces of property that need significant energy efficiency upgrades in order to meet some of these very aggressive goals that have been set by the legislature and the California Energy Commission. And so the large portion at the bottom, the white section, is completely unaccounted for, and that's the section that our program is targeting. At current adoption rates, California is not going to come close to meeting these goals. There are some significant challenges in terms of getting folks to do energy efficiency on their home, as well as getting them to change to solar and other types of renewable energy. Property owners are accustomed to paying their utility bills on a monthly scale. Everybody does it. Our program will be slightly different in that it will be a contractual assessment, which will be secured by a lien on the property. And so the payments will be semi-annual in nature. So that's one of the challenges to adoption. And the main barrier currently for folks to do large energy efficiency and renewable energy projects on their homes and businesses is the large upfront costs that you often incur in these types of projects. So the solution that we're working with is AB 811, as Jeannie indicated, was signed by the governor in 2008, which allows public improvements to be financed on selected parcels as a special benefit. These private parcels, it's done through the 1911 Act as a contractual assessment. No parcel will be assessed unless that particular property owner chooses to participate in the program and meets the program's guidelines. It's not something that will be en masse subjected to all parcels throughout a county or particular jurisdiction. The benefits of this type of program, primarily, it's a significantly reduced upfront cost. If you're doing a $25,000 solar project and you finance it through our program, You'll have some minor upfront costs in terms of an application fee, which will cover some of the due diligence that's necessary on the home and your particular project. But the remainder will be financed over 20 years as part of your tax basis. Second major benefit, the tax assessment will transfer with the property. So if you undertake a large project, you don't have to worry that I just put out $25,000 and I'm going to sell the house in 2 years. When you finance it and it runs with the land, the new owner, whoever is benefiting from the project that was done, will then take up those payments once they purchase the property. The benefit of the property will serve as the security, so there will be a lien on the property, which is a very secure form of debt financing and should ideally obtain some very good interest rates. There's no personal credit involved. We require participants to self-certify that they haven't encountered a bankruptcy in the past 7 years. But beyond that, we're not pulling personal credit, and that's not the main determining factor. The determining factor will be an individual homeowner or business's property and their outstanding mortgages on that property and their outstanding tax basis on those properties. And as I indicated earlier, the financing costs will be administered through their property tax bill, which they're familiar with and they pay semi-annually currently. So just a quick overview of kind of the responsibilities here. I'll get all the text up. So a city or county will opt in to the program, and then once the particular steps necessary for that, including a public hearing and a resolution by the appropriate jurisdiction, their participants in their communities will then be able to apply to the program, get their money for their projects, and repay it through their tax bill. California communities and our partners on the program will be responsible for creating the financing district, providing the full administrative responsibilities for the program, and providing all the upfront capital for these projects through bond sales or through an interim line of credit. It's up to the homeowner or the individual business owner to identify the work and contractor. We have guidelines for that, which I can hit on a little bit. They'll apply to us for financing, and then they repay it over the next 20 years on their tax bill. Some of the challenges that we run into, we started with the program. We went out for an RFP for services on it in December of 2008. And at this point, we're just getting into a position where we're going out with some pilot agencies to try and get it up and running. So it's been a long road. Some of the issues we're determining demand for it. We have this, what we thought was a great idea, but if you build it, was anybody going to come? We did a survey last summer that indicated essentially eliminating the interest rate, no matter what the interest rate was, upwards of 10, 11%. Over 4% of those respondents to the survey would still participate in this type of program out of, just a feeling of wanting to do better for the environment. Program acceptance by local agencies. From a California community's perspective, would local agencies want to participate with us, or would they want to do it on their own? We've had some significant demand in working with us, just based on the economies of scale, but there are a number of local agencies that are choosing to do their own thing. Program acceptance by the existing energy providers and installers. It will be a new model for them, and there may be some lag time in terms of when they install it and when they get paid and those sorts of issues that need to be worked out, but it's not something that we necessarily feel is insurmountable. And then a new legal arena. These bonds are relatively new. They haven't been issued before, so we're going to have to go through the process of doing a legal validation action for jurisdictions that participate. Currently, we're determining to do that on a county-by-county basis. Some of the key elements that we think sets our program apart. It provides for an effective administration and application process. It'll be all web-based. Your local participants will apply online, and most of it will be handled electronically. We offer a reliable regulatory standard in that California Communities has extensive experience with land secured financing. We have a SCIP program where we do these similar types of assessment districts, and we pull them together from divergent districts and jurisdictions and then issue one bond for all of them. We'll provide a guaranteed funding stream for your constituents, and there's very little cost or limited liability to the local governments who participate. There is an upfront fee that will be necessary for jurisdictions who want to participate. It varies depending on the size of the jurisdiction. At this point, I think for the County of Calaveras would be roughly $12,500, and that is subject to change over time because the authority has the ability to do validations on a statewide basis. And if we go out through our pilot program, there's currently 14 counties in the pilot program, and if we go out and do those validation programs and find that it's successful and we don't encounter any issues, it may be, at that point, it makes sense to get multiple other jurisdictions into one validation action, thereby reducing, obviously, those legal costs and the time involved with that. So, economies of scale is what California communities bring. You can build together the demand in multiple jurisdictions. There may be significant demand in Calaveras County. You may get 2,000, 3,000 people interested, but if you can build that between 14, 20, multiple counties, it begins to make much more sense, and it can be done on a much more economic level with one large program. Our platform will be standard program documents. Everybody participating throughout the state will have basically the same requirements. There will be some local customization that will be allowed. A lot of the jurisdictions we're working with now want to build special websites and provide additional information for their particular jurisdictions, which is something that we can work with each local agency on. As I mentioned, the judicial validation will take place to address the legal questions surrounding the first lien priority and a few other issues. What we're doing right now is on March 10th, the authority will be meeting to confirm the resolutions of intent from the current participants in the pilot program. Once that's done and we approve the report that's required under AB 811, we can then begin the validation process, which is scheduled to begin probably late March, early April, which will take approximately 90 days. And then, assuming those are successful, we'll be at a point where we can start marketing and making the program available to constituents. Another main benefit of the program, and all these types of energy efficiency programs, ideally is job creation and job growth. We'll be helping the local in terms of installers and resellers of these technologies, as well as on a regional and national basis, just general industry growth. So the process, real quickly, a city or county will pass a resolution to join the program. We'll set up the program for your jurisdiction, working with whomever is designated within that area, validate the program. Property owners will voluntarily sign up, as I indicated earlier, and install the project. Proceeds from our bond issue or an interim line of credit will be provided to the property owners to pay for the project, and then they'll repay that debt over up to 20 years on their tax bill. In terms of what the property owners are going to go through, there'll be significant education done. We're planning some workshops, providing a significant amount of information online to make sure folks understand the process and what they're getting involved with. They'll apply online. We'll go through a property and project screening. There will be certain requirements for properties in terms of debt ratio. For example, private homes will typically be at 80% of lien to value ratio for their private debt, and there'll be a max of 2% tax debt on the home on an annual basis in order to participate. So we go through that screening. The property owners will have access online to check their status. Once they are approved, they can go out and have their project installed, and then they can submit their funding request afterwards. When they submit their funding request, they'll have to submit a great deal of paperwork related to who installed it. There's some energy efficiency studies that need to be included, as well as rebates and other information. So what we're doing is we're piggybacking off of a number of existing state programs, such as the California Solar Initiative, who already do inspections of these types of projects, so that we don't have to recreate those wheels and don't have to pass on that additional cost. So there will be a significant percentage of these projects that will be inspected so that we can ensure that the program is providing the benefit that we expect it to. So here's just a list of some of the potential technologies that are included under renewable, under the three categories. Renewable energy and energy efficiency were authorized by AB 811. Water conservation was later authorized late last year by AB 474. Here's just the fees that are currently in effect for the program. The legal invalidation, obviously, it goes to mainly legal costs associated with doing that. And then the marketing and technology setup is getting all the information for local jurisdictions into the database and developing the marketing collateral and website for those particular jurisdictions. Just to go over a bit about the team, as I indicated, California Community Joint Powers Authority, we've issued nearly $10 billion for infrastructure projects at this point. You may be familiar with the Prop 1A financing that went through our authority late last year. Through our RFP, we selected Renewable Funding, who would be the main program administrator on the program. A lot of their folks came from the Berkeley program. That was one of the first to use a slightly different model. They used Melrose instead of these contractual assessments. And they're one of the leading organizations in the PACE, or the Property Assessed Clean Energy field. And as underwriter on the program, we selected Royal Bank of Canada. They're a very large firm doing over $100 billion in municipal bonds since 2004. They further work with CSCDA on our SCIP program. So they have experience in land, secured finance, and secured finance with the CSCDA and on a multi-jurisdictional basis. Right now, the expected timeline, our board did approve in January 2010 the first steps and the resolutions of intention from the local agencies. We expect the validation action to begin in early April after my board approves moving ahead on the 10th. After a successful validation, at that point, as I indicated, we'll be able to market the program in those jurisdictions. And we believe we'd be in a position in late summer to possibly bring in additional local agencies and start the process for them, assuming the validation goes well and the marketing and the program is off and running at that point. That concludes the main slide-based portion of my presentation. So now I'm happy to answer any questions.
Do the board members have any questions or comments for Terrence?
Terrence, if you could go back to the slide where you showed the county fees.
Sure.
So you started off, you were talking about, okay, for our county, it would be 12,000.
Yeah, I went through a pretty quick call for that.
And that 12,500 would be at the onset of an annual.
No, it's not an annual. There's no ongoing fee directly to the county. This is just to start the program because we have to do that validation. We have to get particular kinds of information into the database. We have to build the site to accept information from your areas. So that's where that fee is.
Okay, and I have one other question about the contractual relationship. If the homeowner makes arrangements with the installer to put on $20,000 worth of solar panels. I saw one other presentation on this at a CSAC meeting. Was it Solano County or
Sonoma.
Sonoma County, where they were doing it on their own. So that this is a solely separate arrangement. You folks are to spare us the burden of setting up a standalone system in the county.
Exactly. We provide a turnkey option, essentially. Sonoma County has apparently the ability to put their own financial backing to the program. They're funding projects out of their general fund and other special funds, my understanding. That's not a position California Communities is in. We're Joint Powers Authority. We're a conduit issuer, which means we don't have any general fund or any backing of that sort. These bonds will be based upon the market issuing them to investors, and then that funding will be passed through to participants.
But one thing that sort of got my attention is you said that there may be some delay in the contractors being paid for the work. That's a kind of non-starter for a lot of people.
Well, understood, and that's a timing issue that we're working on, and we're working with renewable funding as well as the contractor kind of industry to streamline the process and to figure out exactly how it works. We're currently in discussions with a couple banks on a line of credit that would allow for on-demand, as projects are approved, you can go ahead. But we're not going to be in a position through the program to pre-fund the project, because if we pre-fund a project, issue bonds for it, and then it doesn't happen, that there would be significant negative costs to that participant in terms of 15-20% possibly, because these bonds are typically non-callable and there's lots of issues involved with that. So a project will have to be installed prior to receiving funding through our program.
Okay, and this is my last question, but in the Sonoma County model, there, as I recall, the spread that they were essentially setting this up so that the interest rate that the homeowner would be paying was 6 or 7%, and that was a good thing for the county because they were using excess or reserve deposits to fund this very, very secure investment, by the way. But you mentioned 12%?
That was just what we did last summer, was undertake kind of a demand survey just to see at what point someone will participate or when won't they. We expect currently the actual interest rate to be in the 7.5% to 8%.
That was, really what it was saying, okay, if it got up this high, would you still be interested? And the answer was yes. And then, as far as that particular issue is to the upfront costs, those are the kind of things that we're working through now through the pilot program. So we answered that particular question to say, okay, if it's a non-starter, we found that out in this process to make sure we hadn't marched down a path and then have to unwind it.
Just very quickly, regarding the nature of the programs, with Sonoma County, they funded, they financed the projects through their treasury, so they had a lot more control of the interest rate. With California First, we're going directly to the capital markets. And so you don't exactly know what that interest rate is going to be until you actually sell or issue the bond. The huge advantage of California First is that it is the aggregation of the bond volume. So you get a much larger bond structure, which one, allows for institutional investors to be involved, and two, allows the bond to be rated. And Renewable Funding has been working very closely with Barclays Capital to go to major rating agencies such as Standard & Poor's to introduce the concept of PACE, Property Assessment and Energy bonds, since it's so new, and especially California First. So we're trying to prep the market right now.
Gary?
How does this work with other incentive programs, like PG&E has some incentive programs? Are you piggyback on those type of?
Yeah, the program is designed to take advantage of many of the existing rebate programs, such as the California Solar Initiative and others. It doesn't prohibit participation and receiving those additional benefits.
Do you have any estimate? The funding part of it, I understand what you're saying. But typically, do you know how long it takes for a contractor to install a typical household panels? Are we talking, it takes him a month to put them up, and then he takes 30 days to get paid, so he's extended 60 days actually?
I would say for the Berkeley program, we turned around the payment to the contractor within 15 days. We're actually doing it in San Francisco standalone program, and that also we're going to turn that around in 15 days. So we've set up the program so that it's fast. The issue with the revenue bonds is it's a lien that's attached to the property, that's attached to the property. The person who buys the bond wants to know that a project has been installed, and you're not talking about something ethereal. So that's just kind of the nature of a revenue bond, that it has to be installed. I think in the case of commercial installations, which is naturally going to be larger, there is the possibility of looking at kind of a payment stage, like an installment sort of deal. But of course, that again would have to rely on there at least being some sort of discrete element of the project being finished. So we're working on
That would be in any construction project.
Correct.
So you would go online, a typical applicant would go online, fill out the paperwork. He would be pre-approved, not pre-funded, but pre-approved for his project. He would get a contractor from a list, local contractor you would provide to him, although he could probably go somewhere else if he knew somebody else who could do the work.
As long as they're a qualified contractor in terms of the solar initiative and some other specifics, but yeah.
And then you would contact them, and they would come out, do the work, and then you would take all the paperwork, including the bills, and everything necessary, and send it to you, and then the funding would go to them.
Exactly.
That's all I have.
Steve?
I want to go back to your original needs assessment and poll. You said that roughly 4% of the people surveyed indicated that they just want to do the right thing no matter what it costs. I would imagine those would be people who have a little bit more wealth than my constituents. So I'm curious about the other 96% and where, how that broke down, and particularly how it relates to your 7 to 8% estimate.
Right. And have you seen the survey much?
Yeah, you probably know better than I do.
The survey, it kind of asks them staged, if it's at 8%, would you still be interested if it was at 9%? And I think once you got above 9%, it dropped to that 9% interest, it dropped to those 4%. If it was between 8 and 9, my recollection, it was 11 to 15% of folks would participate, and in the 7 to 8%, I think we had roughly 25 to 30% of the respondents said they were interested.
Okay, and getting also further into the bond situation, how tight are these? I know the California bond situation is not particularly, I don't want to say anything mean, but it's hovering around junk status. What's the relationship to letting these bonds in relation to the overall California scene? How independent is it from that? And why does it appear to you at this point, with most returns being a little less than that, why would this be at the percentage that you're estimating?
Well, you're right, that the market is in disarray, and there haven't been a lot of these types of, in terms of property assessed deals going on. In terms of our SCIP program, we haven't issued one since early last year. We're on schedule to do one in this first quarter. But the security for these is so strong that you're not going to have a direct correlation with a particular county or a particular state's interest. Their current status in terms of ratings, you will have, there will be some negative impact, but it's going to be in a few basis points in terms of it being in California generally. But since you're getting a lien on the property that will have priority over all private mortgages on that property, you have a very secure position that those bonds will be in. So,
If I can just kind of add to that, this is not a general obligation bond, it's a revenue bond. Typically, revenue bonds, or at least those that are tied to property taxes, there's very little default. And so the biggest, frankly, issue here is not so much the kind of borrowing capacity of the state or municipality, because it's not a general obligation bond. But it's the newness of PACE bonds. The only PACE bonds that are actually out there are from Boulder, Colorado. They total about $10 million. So that's one, the extent of market familiarity, and two, that's also the extent of the liquidity. So it's one of those things. That's why we're actually working with the capital markets to introduce them to this. But certainly we expect these rates to go down over time. But at the end of the day, as Terrence said, it's an extremely strong security, that being the senior position on the property.
Right. That was helpful. I'm real curious about why the rates would start at that level, and that does explain it. I guess that leads to some strategic decision-making on the part of consumers as to when they might enter the program. This gets to another issue for me. You had a very impressive list of possible projects. Thank you.
Sure.
And I'm curious just how, do you anticipate the opportunities in this county, should we enter this program, to be the full scope of that, or would we be limited in some way, and if so, why?
Simone can speak to it as well, but initially at least water conservation is not going to be available because right now there's no efficient inspection and other programs to piggyback off of to make that an efficient and cost-effective measure to work on right now. So we built it into the program so that we can make it available at a later date, but it's not going to be available certainly in our pilot. In terms of the other projects, those are going to be available based on what a jurisdiction would like to make available, but they will be whittled down in terms of what's available on a case-by-case basis. Each home will have to have some sort of energy efficiency audit done, and then that audit will provide what's called a loading process, which will determine what are the most cost-effective steps for a particular home or business to reduce their energy. So prior to someone doing solar panels on the roof, we're going to need to make sure that their home is fairly efficient, at least up to date with either if it's a pre-2005 home, they'll have to receive roughly 10% energy efficiency savings from other measures prior to doing a solar installation, because a lot of the federal as well as state programs and grant programs that we're participating with require that, because they don't want to just finance renewable energy side if you're just pouring that money out single pane windows with no insulation in the ceiling.
And just to add to that also, just kind of bringing everything back to the capital markets, the potential bond buyers also like to see a loading order. It just means that the property owner who's actually taking out the financing is going to see a much more maximize the cash flow from their projects. So in other words, you know, the property owner went straight to solar, then often a lot of people are thinking, well, wait a minute, the house may not be that energy efficient, so they're not maximizing their savings. Here go their cash flow for paying off the bond, or the debt service on the bond is not as much. And so actually the bond market favors seeing this sort of loading order. It just means the participating property owners in a stronger position to pay back.
Who pays for the energy efficiency audit?
Yeah.
That's included in that would be the homeowner, the individual participant who would pay that.
They pay for that up front, it wouldn't be part of this.
It can be built into the cost of their project. They're contractor, but many of them are PERS rated or BPI rated. There's a multitude of different types of ratings that folks can have, and that would be built into their cost for the project.
Would that include, you said a 10% efficiency, if they're pre-2005 or they're an older home and they don't meet those requirements, so in order to get the funding to do what they want to do, would their fund be funding available to bring the house up to those specs?
Absolutely.
There would.
Yeah, they can do any of these measures through the program. What the loading process requires is that before they do the solar panels, they have to get insulation in their attic as well as sealing their ducts, and that brings them up to 11% more efficient than they were before. Now they can also do solar.
All right, thank you. I got one more question, which has to do with jobs and local contractors. I'm interested in how our local contractors qualify. It would seem that we have, we're a small county, and we've got some fledgling operations, which are, I think, very good. And actually, I've got entire roads that are solar now because they're way beyond the grid. But we're interested in how you would arrange your business to be able to effectively respond to any opportunities that come up. Many of our folks are in 1, 2, or 3 of these things. It would seem to me that some form of collaboration, some joint ventures, some things to get our local businesses ready for this kind of volume and scope. What do you have in mind for that? Is there any assistance? Are there ways that counties that are just building their infrastructure in relation to this could move or accelerate their capabilities?
Right. As part of the program, we'll be going out to the local installers community, the contractor community, educating them on our program, on the requirements of our program, so that they understand what it will take to participate. But in terms of like the majority of the program, you're going to have to obviously have a license. You're going to, if you want to do it, you have to be part of the California Solar Initiative. There will be minimums in terms of assisting them in building that infrastructure. I don't have any experience in that. If Simone is.
We continually speak to contractors, just kind of let them know what's coming down the pike. What's happening in California Solar Initiative extended their rebate program to the hot water, solar thermal. So we just kind of as Darren said, we're just giving you a heads up of what the qualifications are and the time to get there.
All right. I would hope there'd be some partnerships in small business administration. You can get financing to get some of these done, but without the infrastructure on the ground, the accomplishments will be diminished. So I'm looking for, maybe this is not the, obviously the finances are separate from the on-the-ground aspect, but I'd sure like to see some engagement on that latter issue from some agency.
Absolutely. I mean, it's a great thought, and there are a lot of collaborations going on. From my perspective, I'm focused obviously on the finance side of it, but it's definitely something we'll think about. We've had discussions with some of, as you mentioned, some of the utilities. We've been in discussions with PG&E. We've been in discussions with SMUT. So there are collaborations going on, and I think those will just continue to grow, and we should definitely look at including as much of that as possible.
All right. Thank you.
Mr. Triano?
Well, I'll give you my 2 cents worth. I'm not in any way in favor of a program such as this. Particularly in this environment, it sort of surprises me that we're still sort of doing this. It's like, oh, we can help the economy by having bigger government and more government, and let's start a new government program. It's not. It's almost like on the condemnation issues, where in my opinion, the intent was for on condemnation that it go basically in the government's name for a government project. Basically, infrastructure, whether it's road, sewer, water, whatever, not to just give it out to the private sector to build shopping centers, etc. And yet, you're coming before us, and here's financing, etc. Not to do the things that county government should be doing, which is roads, water, sewer, and the like. But we're supposed to basically be like Freddie and Fannie, which is what we're representing, and we're going to make loans out to the private sector. It's sort of like, well, the problem here is we don't have enough debt against our homes, so let's give them some programs where they have more debt against their homes. Also, from your criteria, since this is basically significantly a subsidy program, and somebody has to pay for the subsidy, what's the direction of wealth in a program such as this? It's basically poor people subsidizing wealthier people, because it's the wealthier people that Steve sort of hinted at initially on one of his comments, that are eligible for this. It basically wipes out a private contract in the sense that you have a first trustee on your home. It's not a first trustee anymore. It's a second trustee, because this becomes the first trustee. This is a priority of debt, of which the first trustee or the second trustee doesn't even have to do a subordination agreement. So you're wiping out the private contracts in the process of doing this. So I just, if this were a good idea, then it should remain in the private sector. There's no reason to come government for it. And having government involvement and using up a lot of our staff time, et cetera, doing things that really have nothing to do with county government, state government, or federal government, in my opinion. This is something that should remain entirely in the private sector. I don't want to get into my thoughts on AB 32 and global warming, Steve's comments that they're just 4% just want to do what's right. We could get a significant discussion of why is this right? Why is it sort of right? And you have to have subsidies, and you have to transfer wealth from poor people to wealthier people, and you can get into the science of global warming and all that. It's basically the emotional impetus behind a program like this. But I don't think, I voted against when we had community development block grants said, we could make loans to aspiring businesses. And oh, the board just thought that was great, and we're going to make loans to aspiring businesses. And I basically gave the same argument, why is the county government doing this? This has nothing to do with government loans in the private sector. We made 2 loans, one went bankrupt, and the CAO, after we went through the bankruptcy proceeding, and the other loan was sort of constantly in default, and then when we finally get to the last moment, we would bring it into conformance because it has such a subsidized interest rate, and there was, I don't think there was hardly any penalty for the default period. The CAO said, boy, we're not going to ever do this again. And the board members that were here at the time said, boy, I'm never going to support doing this again. And here we are, making loans and going out and financing them. And, to me, it makes no sense at all. I mean, this is absolutely what government should not be doing. The government should stay the heck out of the private sector. It would just be wonderful if the government could take care of the damn public sector that we're already committed to without basically having an expanding program. My God, we don't need another government housing program. We didn't learn anything over the last year. We should have learned that we don't need another government housing program. And this is all part of housing. So I am not in favor of proceeding whatsoever down this avenue. So those are my comments. Thank you.
I have some questions. You mentioned there's a 20-year payback. Can it be reduced at the recommendation of the property owner?
Yeah, the payback period is based upon the projects that are installed. 20 years would essentially be maximum. If they don't do solar and they do a solar hot water generator and some other things that don't have a long enough lifespan for a 20-year financing, their particular financing will be shorter. It will be based on the expected useful life of what's installed, and it will vary based on.
So the use of the life of what's installed,
Exactly.
not the dollar amount.
Right.
Is there a pre-inspection also? And who does that? Pre and post?
That's part of it, in terms of determining a baseline for a particular project. You come in and you test the home initially and you see how their ducts are, what sort of loss they're seeing through their home, and then based on that pre-inspection, you can determine a list of the measures that make the most sense for that particular home, so then they can determine what measures they would like to have installed in their home.
So if someone has single pane windows and they want to put in double pane, they still need to go through the energy audit to do that.
Yeah.
That's a mandated component
The-
of the program.
There are kind of 2 paths. There's essentially a prescriptive path where if you do A, B, and C, or your home is post 2005, you don't necessarily have to go through the audit because you're installing all the necessary measures to bring you up to as efficient as you can be. And then the second and the path that we would suggest to most folks is going through the energy audit version of the program.
And are the energy auditors, I think Steve alluded to earlier, hired by the property owner?
Yeah, that would be part of what the property owner does.
Okay. And the property owner picks their own contractor? The legal validation option, I really wasn't clear. Are you going to do that county by county or cumulative? You talked both ways.
Right. Initially with our pilot, we're going on a county by county basis just because that's a more conservative approach. When you do a validation action, essentially you're suing yourself and making it open to others to comment on what you're proposing. And we're going to notify widely in terms of lenders and the mortgage community so that they have some input during the validation process. We'll do it on a county by county basis. That way, each county that we work with in the pilot stage, jurisdictions within that will be able to participate in the future. If we did it, say, in a city, then no one outside of that city could participate moving forward. If we validate it on a countywide basis, other cities can choose to join in moving forward, and they don't have to redo the validation process. Once we get through that, and if it's successful, we may look to utilize our authority to do a statewide validation. The drawback with a statewide validation, certainly up front or even possibly down the road, is that if someone protests or puts in a claim as part of the validation, our fees and the cost of the program weren't designed to fight a validation action. They're designed to fight an uncontested validation action. So if someone does protest it, it's likely that that particular county in the pilot phase may be dropped. And so I don't need to indicate that we have a fully baked program. As Tom said, we're definitely working through the kinks as we move forward. But did that explain kind of the different paths that we're looking at?
In this county, there's only one incorporated city.
Okay.
Does that city have to partake for the county to be eligible?
No, they don't have to. How we're setting up the program is that the primary jurisdiction would determine whether or not the program is available. So for a county, if a county participates, anybody within the county is eligible, but if there is an incorporated city, we would not offer the program in that city unless they chose to participate as well.
At what point would a resolution of intent be required by this board if Calaveras chooses to participate?
That would be this summer. We would get into that because
At the earliest.
At the earliest. What we want to do
So we have to be accepted into the program before we did a resolution of intent, as required by ABA.
Yeah, you guys would do the resolution of intention to participate in our program, and then our board would confirm that resolution, and then we can move forward with the validation and whatnot for your
So if
county.
we wanted to do a resolution of intent in 3 weeks, it's really mute until you open it up. Is that
Exactly, because we want to make sure before we go too far with it that we have a widget that works.
The 12,500, I'm still not clear. If that's a cost to Calaveras County, non-reimbursable, or if that's reimbursable as part of the package.
We could possibly build it in, but then it would be borne by the participants in your county if we want to build in that cost. There may be, in the future, there may be opportunities to reduce that cost through the single validation, as well as there may be grants available. The folks who are currently participating in the program all applied through Sacramento County to the California Energy Commission as part of the SEP program, which essentially was a grant program, and they received significant grant funding to offset those costs.
Well, Calaveras received a grant from the Public Utilities Commission, but it's for retrofit on the government center, not for this. You're not talking about.
No, this was a very specific grant tied to AB 811 and the California First program. And so there may be opportunities, I can't necessarily speak to what will be available, but that's just how most of the current participants are approaching it. And as you indicated, a number of the local agencies who are in the pilot had indicated that if the grant doesn't come through, they're just not in a position to participate. And we understand that that's a cost.
So are you helping those pilot counties obtain the grants or their upfront costs?
They got together with renewable funding as well as Ecology Action, which is another nonprofit that works in this environment and applies separate from California communities. We're not in a position to develop or handle the grant process. We're very streamlined.
That's fine.
Okay.
So is it working? Are you getting funding for these?
Yeah,
We received $16.5 million through the state, through Sacramento County, but their application to this.
For those upfront costs?
Largely the legal costs that are involved in setting up these districts, first of a kind. Just very quickly, the validation process is required. One, it's done before community members actually come into the district. But two, it's just required since AB 811 is so new. It's just to kind of provide legal strength to the district.
So is California Communities the one that's doing the validation?
Our program.
And they'll be the one issuing the finance.
Exactly. When we take that administrative burden off the counties, you're not going to have to be setting up the districts. You're not going to be doing all that work. Counties or cities can be involved as little or as much as they like.
I just want to let the board know we did use you to securitize the property tax. We used you for for lease purchase. So, we thank you for the $1.5 million net to us. I do want to comment, of course, on Mr. Tryon. Surprise. I mean, this is a voluntary program for the public. I mean, for property owners. This is not mandated. It's just a way to help property owners become more energy efficient. I don't look at it as some of the concerns Tom had where we had CDBG grants for businesses that was using public money to help them. In this case, we're just the conduit, but there is a no net cost to the counties or cities to do this program, and it's a real benefit to the public, to the property owners. So it's nobody's twisting their arm in any way to participate. So anyway, I understand where Supervisor Tryon is coming from. I just disagree. It's a surprise. I would like to open it up to the public if you have any comments or questions. If you have questions, we're just going to take notes on your questions and respond at the very end. Thank you. Yes, please identify yourself. This is a study session only. The board cannot take any action. We can give direction, and I'm only giving you 5 minutes. Per person.
I won't be able to use anybody else's, right?
Can't use anybody else's time, Mr. Caldwell.
Good morning, Madam Chair, members of the board. Gary Caldwell, Valley Springs. I read a summary of the AB 11, and I thought I saw in there that one type of real estate that was eligible was schools, and I was wondering if that's true, that there are publicly owned buildings that might avail themselves of this program. Is that true?
Okay, Gary, we will just take the questions and respond.
Oh, okay.
Thank you.
If so, obviously I'm thinking of the jail. As you know, I testified 3 weeks ago about solar improvements to the jail. As far as a GO bond versus a revenue bond, I don't see the distinction here, because the GO bond is also secured by the property, the ability of the county to collect property taxes and pay off that GO bond. So I don't see the distinction. It might be more favorable to sell the bond on the market, and I would think it would be, but the vehicle to collect and repay the bond, make the bond payments is still the same. My wife and I were recently in New Orleans, and we hadn't been in the city for a while, so we took another city tour, and we went out to the lower 9th Ward, and there's some construction going on, most of it financed by Brad Pitt, but some construction going on of new homes.
Finance my house.
And about every 4 or 5 lots, there's a new home going up. And I asked the tour guide, why aren't they all being built on? Why aren't the lots being built on? And he said, because the FEMA money, even though there's billions of dollars of FEMA money that went to the area, the FEMA money is a reimbursement program. These people don't have the money to put out to begin with to finance the building of their houses and then wait for reimbursement. And if I'm understanding correctly, that's what Mr. Sweet, I didn't recognize, sorry. I didn't recognize or didn't realize, I should say, that this appears to be another reimbursement program. So in other words, somebody has to be able to afford the outlay of whatever it is, 20 grand for solar photovoltaic panels on the roof, and then submit the paperwork and the receipts and so forth and get reimbursed. You have to have some money to begin with in order to be able to do that. And as was pointed out by Supervisor Walensky, that this is maybe not for everybody. The other was the parameters. I think if the board's going to get involved in this, one of the things that I know everybody realizes is that there's a number of foreclosures, and there are people that are below the water and have a property that the mortgage amount is higher than the market value of the property. I just went into a discussion with my insurance man about our insured amount versus the market value amount. And it turns out that you may be in a position where you don't want to have a property take part in this program where they don't have a certain percent of equity. And I thought I heard something like 20%. And I would suggest that you get more than that. And I think too, the board doesn't want to get into the foreclosure business because that's your recourse. If the taxes aren't paid or the payments aren't made on the bonds, then you're going to be foreclosing on the property. And I assume if it works like most non-payment of taxes, it'll take 5 years. Somebody's got to make those payments for 5 years before the property can be sold for taxes, delinquent taxes. The other thing I wanted to mention was that if this is in fact available for public buildings, even though the majority of the board, after 3 weeks ago, did not find it prudent to set aside some portion of the $59 million you're spending on the jail to put in solar improvements, this may be an avenue if you can actually get a low-cost loan. And when I say low-cost loan, I'm thinking of less than 9%. And I don't know if those are out there. I see that in the Bay Area, the Bank of America, Wells Fargo, and some other lenders are involved in this program. So I would think if you can borrow money somewhere closer to the 30-year mortgage rate at 5.5%, then you might want to get involved in that because you probably can't borrow that as part of the jail project on your own. Thank you.
Thank you, Mr. Caldwell. Does anyone else have any comments, questions?
Good morning. Bill Sost here, Angels Camp, also with the company Evergreen Technologies. Our company is the one that performs those pre and post inspections you guys were referring to. A couple things these guys did not bring up that I wanted to point out. When you look at that upfront cost of $12,500, you need to also know that any of these projects that take place require a building permit. This is a revenue stream from the county, for the cities, any of the group that are participating, because the homeowner must buy a permit. All this paperwork, everything has to be properly documented and inspected. So you guys may want to add that in for these different presentations to let different supervisors know that, yes, in fact, that's one of the ways to make back that revenue. We talk about energy efficiency. We're talking about helping people out here. We need to save money. We know that California homes leak. We waste energy like crazy. And I'm sure all of us can go back to the 1974 OPEC oil embargo and what happened. Does anybody want to go back to the days of leaded gasoline and not having catalytic converters? We know that those improvements have helped us. We know that having the federal and state emission control standards have actually helped us. So this is basically just an outreach of these same programs. How can we save money? And I will go ahead and throw this out here to the Board of Supervisors. If you guys would like to try a field trip, okay, let's pick one of your homes. Let us come to one of your homes, let us set up the equipment, and we can show you exactly what this is. What does it entail? This is an open invitation to the entire board. Pick a home. Yours, Mr. Walensky, I'll be happy. We'd be happy to show it up. And let's go out there and let's show you. We've seen this. I have clients, we've already inspected their homes where we have people sitting there in the wintertime at 60 degrees in their house because they can't afford to turn on the heat. With some basic, simple improvements, I know our business partner saved 25% of their propane bill in the month of January over last year's bill, just because we sealed up the ducting properly. So the money can be saved is huge. And more importantly, the energy that can be saved is huge. As a retired military member and someone who has a son currently serving in Iraq, I know I don't want to be held hostage to hostile third world countries where we have to get our energy from. And this really comes down to that. We're talking about jobs. We in the private industry are the ones who are trying to hire people. There are a lot of certifications we have to go through, both as HERS raters, as building performance inspectors, and different contractors are here with us today. There are quite a bit of certifications required to get to this point. So we have a significant investment in this type of industry. But the best news is there is a lot of ways we can improve. There are a lot of ways that we can bring in, we can hire people to do a lot of these different inspections and the contracting work. So the money's there. And of course, from the county level, you have your building department, building permits. There's a lot of revenue, a lot of ways to increase jobs there. Quick question for you gentlemen, if I may.
Just ask and we'll.
Just
answer
ask,
later.
the question goes down to the interest rate that's paid on those bonds. When we going through who gets the interest on the property tax? Okay, that basically comes down to, so if the property tax has been increased by a certain amount, interest is paid on those, who gets some of that interest? Does that all go back to pay back the bond, or does the county as part of the property tax get some of that money? So that's the open question there. The last one was on water conservation, even though these gentlemen said that that's not part of it. I know typically when we are certified through the Building Performance Institute. So when we go out and do a full building performance inspection for someone, pre-inspection, we look at all the different ways that you can conserve energy. And that's part of our standard report we give to homeowners, is to how can you save anything? Water, energy, you name it, the whole shop. All right, that's all I have. Thank you very much for your time.
Thank you, appreciate it.
Good morning, Timothy Dondero with the Sierra Business Council. Just wanted to point out to the board that currently we have Sierra Nevada Energy Watch serving Calaveras, Tuolumne, and Mariposa counties. Provides complimentary energy audits for municipal and commercial customers. So I'll be able to partner on with this. Also wanted to point out that both Sonoma County, local power, and other agencies are using this source of funding to provide those grants, and so we're rolling that program out for all small businesses and municipalities. This county in particular could use the leverage of Tuolumne and Mariposa counties to pay for these grants, I believe, and AB 32 and other climate legislation is going to come down. Rather we take the stick or the carrot on this, so I think getting in front of it is a great idea for the board to consider revising their opinions on climate change.
Thank you, Mr. Dondero.
Mr. Dondero, congratulations on your new post.
Thanks, sir.
Hi, I'm Rod Withers. I have a list. Hopefully I can do it in 5 minutes. Do you have some model numbers for existing cost per month average of the PG&E rebates versus the power savings? Just some model, things in the counties that you're already currently working with. What sort of support staff do you guys provide for assisting homeowners? How are the other counties doing right now as far as where they are as far as in the process? Does the funding pick up all the balance of the costs less the California rebates that are available? In other words, a zero upfront cost basically to the buyer, or is there an average percentage? I mean, if an average system runs $50,000, is the homeowner going to be ponying up $5,000 up front? I know Victor can probably answer some questions on that. If you're piggybacking, what is on the state stuff? That's what I'm asking. Is if you're piggybacking on that whole system, does that pick up all of that?
Rod, when you say piggybacking, are you talking about existing programs?
Yes,
through
correct.
the state?
Correct. Yeah, the refunds that are available through the
Okay,
state.
so
Victor's very.
okay.
He could probably add on to that of what's available. Do you offer support for ensuring that the contractors are approved, and are you going to provide a list of approved contractors on the website if you do this for the county? I know this can work with, in conjunction with the local building departments regarding, the process and the finals and the inspections and everything. Can the inspectors get qualified to increase the revenue stream to the contractor? In other words, when they go out and final the system, can the inspectors get qualified through the state so that will so that it speeds the process, so you don't have to have one more inspection after that through, to speed the process for the, like you said, you're working on trying to get basically a 2-week payment plan to the contractor, which seems reasonable. But if it can be done through the building department, that they've gone out and been certified and can certify the system works properly and everything, then it could bypass one more step. Can the contractors through the Bank of Canada get qualified for a line of credit so that in case that revenue stream is slow, can they work in conjunction with your program, with the bank, so that they can create essentially a line of credit based upon the job that they're doing that's under the program, so that they can essentially help with their upfront costs? Because nobody's just got thousands of dollars lying around to buy panels. Are all of these only? Is this program only for retrofits, or can it also apply to new construction? Because as soon as it's final, if it's only for retrofits, as soon as it's final, I guess it would be up for available part of the program, but that doesn't make sense. It's like, working backwards when you can preset up things for the program if it can apply to new construction. Right now, I know Victor can expand on this, but the return on investment for typical homeowners after the rebates runs about 7 to 13 years with what they're getting for in other words, if they're not paying out the PG&E bills, their return on investment is about 7 to 13 years. So essentially after 13 years, roughly, would be kind of max. Everything else after that's kind of gravy in comparison to what they'd be paying out in their increased taxes. So just kind of your thoughts on that. Do you also help provide local realtors with helping to pre-qualify homes for the program? Because you said that the program only allows for certain homes to be able to be put into the program. How are those done, or how are those identified? Is it only through the inspection, the energy inspection? And that might be something that's worth doing for home marketing for a home that's maybe after 2005 that needs a lot of retrofits. But if they can qualify for the program, it might help make the house more sellable because they know that they can retrofit it and do all the things and know it's just going to get lumped into the taxes instead of having to come up with some more upfront monies.
You've got 30 seconds.
And
if you like, and you've got a lot more, then you can give us...
I'm almost done. So do you see a problem with the quality of the program? Let's say, I don't know if you've run into any of this yet, but if someone wants to put the program in and their home qualifies, but their neighbor's trees are in their way, does that come under that liability thing that you're talking about as far as that you guys are willing to take on in the legal sense of things? Can the county reduce their upfront costs in lieu of the grants by the permit fees and inspections? Can they tag that on as a so much percentage to recoup that 12.5 a little faster, and then maybe apply for the grants anyway?
That's it. Yeah.
So one quick one, so the maximum available right now through this is an 80% is to qualify under that is an 80% loan to value ratio on the residence. What happens if the property changes hands within that, just right after that period of time? Then the new buyer essentially, does he have to qualify for that in the same sense as the previous owner? Okay.
Thank you, Rod. And if you have other questions, you can
Yeah.
to the CA. Thank you.
Victor will pick him up.
Hi, Victor Dio. My company is Sol Sierra. We're one of the leading solar installers in the county. I really want to address some of the questions. There were some really good questions by the board as well as Mr. Withers. And I don't really want to come as a solar installer. I would rather represent our group, SEBA, which is Central Sierra Ecological Builders Association. We've been around for a couple of years, and we're a subgroup of Focus. What we've been trying to do is advocate for green building projects, ADA 11, all these sorts of things, because we know it's the future. We know that if you look around to the rest of the state and the country, that everybody's doing this. We're not trying to reinvent the wheel. I think this California First program is a really excellent solution for Calaveras County. Our SEBA group is made up of lots of people from Tuolumne and Calaveras County as well as Amador County. So we've got several architects, we've got several FERS raters, a couple of solar installers. Well, Bill Soest, he spoke earlier, he's a FERS rater, so these are energy specialists, people that have gone and got the certification training by the state, so they can do all of the certifications that are required now. So with this program, there are certifications that are required. But then if we look back to our regular building process with Title 24, everybody knows what that is. It's been around for a long time. So as all these things evolve, Title 24 requires some HERS rating. And since January of 2010, there's sort of the new, what would you say, the new focus. Yeah. So all these things are happening. There are state green building codes. So we think this is a really good program. And I just want to go back and address some of Rod's questions. Unfortunately, Rod, I wasn't able to make the last couple of meetings, so I could have answered a lot of your questions. In terms of just the solar aspect of this, the California Solar Initiative is a program that's been around for a couple of years now, and we're a participant in that program. Before that, it was called the Emerging Renewables Program, so that started somewhere around 2000, and it has evolved into a really good program. So at the current time, PG&E is the administrator of the program, and I would say it's a really good program. It's evolved, and there are a lot of regulations in place to assure that the installations are done properly, so that sort of thing. You know, it's all evolved to quite a high level. So I see this as just another part of the key to getting these projects done. So I really support the California First model. I wanted to try to address some of the questions that the board had. They had some really good questions. Several people used the keyword 4% of the total number of people that are interested in doing these type of energy efficiency projects. They're the ones that are going to do it no matter what, because it's the right thing to do. So I just wanted to comment on that a little bit. That is true. But the other thing that is true right now, PG&E rates continue to go up, and these same people that are willing to do the right thing, they are also in a bracket where their PG&E bills are at a point where the numbers totally pencil out. So PG&E rate structure has a tiered structure, so if you're using Tier 4, Tier 5 on a regular basis, you're paying pretty dearly for your electrical costs, your power costs. So these systems that we're installing actually pencil out in about 6 years now. Now, I think this program is going to be ideal for the smaller homeowners, those that have more modest bills. because when we look at their return on investment, it's typically 11 or 12 years. So if you've got, $100 a month power bill, your return on investment is pushed out beyond 10 years. So it's a hard pill to swallow for these people. I think this program is going to be excellent for this niche of people because if you look at the Berkeley First program, our company was actually considering being a participant in that program, but unfortunately we were so busy in Calaveras County doing solar that we couldn't make it to Berkeley. But in the first phase of that program, I think the first phase of participants in that program, in 1 or 2 days, they had filled their quota of people that wanted to participate in the program. And the reason for that is because if you look at the monthly costs, they found that if they broke down their assessment over 20 years into a monthly cost, it was going to be less than what they were paying PG&E. So for all those people, it was a totally no-brainer operation.
Mr. Guido, could you please wrap it up?
Okay.
Thank you.
Well, I think that's enough. I can go on and on. Thanks.
Thank you very much. For public disclosure purposes, I do have to say Mr. Guido built my first home.
Hello, I'm Tom Danielson. I'm a building contractor here in Angels Camp. I'm actually a performance-based contractor. I'm a verified building performance contractor by Energy Star. Actually, I've been put to work. I've been awarded a contract in San Joaquin County, so we're putting 6 people to work from Calaveras County to San Joaquin, and I believe it's 8811 money. I'd just like to share one thing. About 5 years ago, I was involved in a project here in Angels Camp. A local builder named Ron Selleck built the house, and I was hired by the homeowner. And I was hired to do the energy upgrade. We took care of the insulation. I took care of the HVAC. The homeowner has monitored his house for 5 years. Standard built construction, 2,500 square foot house. We're at about $550 a year heating and cooling costs, so under 30 cents a square foot. And the additional upgrade on the construction was $12,000. He figured his buyback was in 3.5 years. So proving and putting energy efficiency in a home and actually testing it in and testing it out actually does work. And if you guys wanted to see the proof of the bills, I'm sure that he would be available and we could put a presentation in with him to show you what his actual costs are. And actually, Ron Selleck built the house next door, and none of the energy efficient measures were taking place in the house next door, and I'm sure the owner's name is Bill Harrison, has talked with him, and that's where he got his basis, 2 2,500 square foot houses built by the same contractor side by side with incredibly different energy costs. Thank you.
Thank you, Mr. Daniels.
Morning, Jan Schmidiger, Hardy Custom Builders. I live in Sheep Ranch. Yeah, I think this is a good thing for the people. And as part of our SEVA, we're a 501c3 nonprofit. So we would have access to grants, and we would be willing to look into finding the funding for your $12,500 to help offset any concerns in that area. We can also work with Sierra Business Council. We're very close with them in collaborating on these forms of energy efficiency programs. And I just think the people need the opportunity to make this choice for themselves.
Thank you.
Mickey Williamson from Murphy's. I actually wasn't planning to talk today, but I was inspired by the conversation and just wanted to give you my perspective as a homeowner who was interested in these issues. A few years back, our household decided that we did want to do a solar installation, and we paid, first of all, $500 simply for an energy assessment of what our current electrical use was. and learned what the different appliances and things that, how much energy they took. And just based on that, we realized that many of those things were not worth the amount of energy that they were taking. And so we made some other choices about our energy and reduced our PG&E bill by a third just with that $500 investment. And we decided that in our case, at that time, solar did not make sense, so we used the money that we would have put into solar to buy a hybrid car and figured that would be our contribution. But a few years later, we decided that we really did want to do solar, even though in our case, it doesn't pencil out probably in our lifetime because our bill is so small, but it just felt like the thing that we wanted to do. And I just really would appreciate this kind of a program for the people who, I mean, we were able to do it because we are under the illusion that we have the money to pay for it, which at the moment we do. May not last our lifetimes either, but for people who don't have that, who really couldn't do that up front, this kind of program would really be a great advantage so that it's not simply those who have the resources that can participate in these kind of improvements.
Thank you. Did you see the article in today's record?
No, not yet.
Oh, here. That's about the Calaveras Humane Society.
Oh, thanks, Marita.
Hi, I'm Michelle Plotnick. I'm an architect in Murphy's. I wasn't planning on speaking today either, but I was so encouraged to see that this was going on that I had to come down and hear it. And I just want to encourage the board to seriously consider participating in this program if they're able to get it going by summer and have a working widget. Because I think it's a terrific opportunity, and I think that we need to separate personal feelings about whether global climate change is real or not real and look at what's good for the people who live in Calaveras County. And whether it's going to save the world or whether it's just going to save the people who live here some money and give them the opportunity to live in a more comfortable home is really the most important thing to be talking about. So I want to also say that I think the third-party auditing requirements are really important because what's sexy and visible are solar panels, but what are going to change people's lives are duct sealing and air sealing and insulation and better windows and better air quality. So that's it. You guys have all heard enough from me in the past.
Thank you, Michelle. Is there anyone else who would have any questions or comments? Then I'm going to close the public comment portion. I'm going to go back to our guest and let's start answering some of these questions.
Sure, absolutely. Back to the beginning.
Did you write them?
I have
maybe between both of us.
Yeah,
Okay,
hopefully
thank
we
you.
don't miss too many. At the beginning, the gentleman was inquiring about the program being available for public buildings. This program is for private uses, for private businesses, industrial, as well as residential.
That's AB 811.
AB 811. He referenced revenue versus GO and the interest rates that are available. When an agency has taxing power, that they're in a much better financial position than a typical revenue bond. These revenue bonds will be very secure, but one additional thing to consider is that currently they're taxable revenue bonds, which is one of the reasons they're up in the 7-8% range. There is some possibility down the road for it to become tax exempt and for that interest rate to come down even further, but that's a ways off. Then I think the next question I have was related to foreclosure and the responsibility of the county and the term. Under our program, that would be the program responsibility. We would handle that. It would be incumbent upon the county to initiate those proceedings. And under the program, we wouldn't be able to wait 5 years. As part of the program and issuance of the bond, you're going to have a debt service reserve fund, which you can tap, but it's not going to be able to fund out 5 years. It just economically doesn't make sense. So through the program, once you're 1 year or more behind, we would have the ability to initiate foreclosure proceedings.
I want to jump in here real quick. That's the complexity of the whole loading order is to minimize the possibility of foreclosure. The whole notion behind the loading order, as you heard, is to divert people from the sexiness of solar panels and really use the auditor to put the financing resources where they're going to maximize the cash flow, thus putting the property owner in the best possible position to be successful, to successfully enjoy the benefits of this project. I also want to mention renewable funding. So we were the pioneers of PACE, being Berkeley first. In addition to working with California first, we're also working with the City of San Diego, the City County of San Francisco. We're working in New Mexico, Colorado, Maryland, Ohio. In short, we're the leading sort of PACE provider in the nation. Clearly, it's caught the federal government's attention. They have called us, we have called them. We've had a number of communications, including the Federal Housing Finance Authority, with the Department of Energy. We actually go on a number of road shows with the Department of Energy, kind of introducing PACE to different communities throughout the nation. And indeed, there's a representative from our firm in the Indianapolis today. But we have a really good sense that actually our president, Cisco DeVries, went back to, was invited by the White House to go back to Washington, D.C. in October to attend a retrofit ramp-up sort of briefing wherein Biden endorsed PACE. We are in constant communication with the federal government. We understand their issues, and they actually expect us to kind of faithfully make sure that these programs are done responsibly. I also want to say that Fannie Mae issued a letter to all of its lenders, to the lender community in the U.S., that to consider these mortgages as senior to the lien. They say just consider it as any other sort of municipal tax. So these issues are being considered by the federal government. We're at the forefront of it, and we're bringing it to this program.
Thank you. Go ahead, Terrence.
Sure. One of the next questions was related to interest rate and the county getting a portion of that. The program is set up to ensure that the county, in its role as the taxing agent, is reimbursed for the costs that are associated with that. So the county won't be paying for the work done on that. You will be reimbursed through the program. We'll provide to you particulars on each project in the form that you needed through our tax administrator for you to place on the wall, and then the cost that you incur will be reimbursed through the program.
So, to expand on that, we collect the taxes and we put them in late or whatever in our treasury program. We get interest on that. But at what point when we collect the tax money, does it then go back out to you as it does to fire district schools and so forth?
The exact time, that will be dependent on the bonds, and I would assume, and when the debt payments are due. We'd have to work out a schedule where we get the money from you.
Wasn't it paid at the same time people pay their property taxes? So
well, there's going to have to be a lag because a lot of us are late occasionally on our tax. So typically, and not everyone.
Well, we keep that interest.
Understood. Yeah. The interest that is gained on it while it's in your account is the county's to keep.
In addition to that, there's been built-in funding for our costs.
For your costs.
In addition to that.
Exactly.
Okay, thank you.
There was an inquiry about some model statistics for rebate and power savings through the program. Our program currently isn't up and running, so we don't have any model numbers to provide for us. But as what Simone was indicating, with the loading order and the whole design of the program, the goal is to have as much of the annual tax burden be covered by savings. And that's the goal. And payback periods obviously are going to vary depending on what's installed and a variety of issues. So we don't have any specific numbers yet that you can generalize to our program. There was a question about support staff for the program. Renewable funding will be the main interactor with the homeowners and businesses. They will have support staff. They'll have a 1-800 line that folks can call into. Subsequently, after someone's participated in the program, as part of the tax roll, there will be a 1-800 number on there where they can get a hold of the assessment administrator on the program for any future questions regarding that particular lien. Other county status. Currently, we're beginning to ramp up with those counties that just received an indication that they're going to receive the grant funding, that they haven't got the signed contract from the CEC yet, but they had preliminary staff level approval, and we're working with them to to start the rollout process and designing of what's going to happen in each local agency. And then ideally, once the validation action is completed in the June-July timeframe, we can move ahead with that. In terms of upfront costs, there will be an application fee that will be charged when folks apply online, and that will cover the cost of researching the lien and whatnot to ensure that they are the actual homeowner. And then we have to also further define if they meet the 80% test in terms of the assessed value of the property. So there will be an upfront cost from that perspective, but the remainder of the project can be financed through the lien on the home.
Minus any energy rebates, I think that was your question.
Yeah, absolutely, yeah. In terms of, just as an example, solar, they'll have to participate in CSI and that will be taken off.
Okay, thank you.
So in terms of support for ensuring contractors are qualified, we're piggybacking off of the existing systems in terms of building licenses, qualifications, the CSI list. So all those will be provided for local individuals to access, and we'll just be working off of those existing databases of qualified individuals. In terms of getting local inspectors qualified for solar and other rebate programs, that will be on the scope of our program. I don't know if those kind of conversations have gone on to improve the efficiency of those particular rebate programs.
The one about if I understood Mr. Weathers' question, can the county's building inspectors get qualified to do the inspections, or
Right, in terms of,
who will be doing the pre or post inspections?
I think this question was related to, and correct me if I'm wrong, it was related to whether the building inspector can do the CSI rebate inspection as well. And I'm by no means an expert on that, and I'm not aware if they are pursuing that as an opportunity.
That wasn't your question, though, was it?
It was.
Rod, do you want to?
Well, it sort of is. I mean, it is and it isn't. I mean,
could you tell us what it is?
Well,
What's the what?
Can I
Yeah.
just expand on that? I was kind of rushing. Have to get up here. I was kind of rushing to, so I don't want to go over time. But what I wanted to say about the CSI program was I talked about how we evolved from the emerging renewables program, and the program that we have today, I think, is an excellent program. There's a lot of things in place to ensure that those projects are really high quality. And so in terms of efficiency and everything, all those things have been taken care of. So along the lines of the inspections, the CSI program has their own way of inspecting. So when we go through the process, we take out a county permit. So there's a revenue stream, as one of my colleagues mentioned. So the building department is going to see more permit fees coming through. So what we do first is we get a final from the county, and then we take that final and we send it on to the CSI program within PG&E, they're the administrators of the program, and then they have their own people that do the final inspection to make sure that that system is worthy of being interconnected to the PG&E grid. Okay, so that should answer that question. So that, I think all those inspections are really taken care of already. So there's not another layer of government that we're adding here.
Rod, does that answer your question?
yeah, I was just trying to do what he said, to just not have another layer of
there's not
inspections.
No, there's not another.
Well, maybe as an adjunct to that also, as separate from the solar is the HERS rating. So if you're going to do the energy efficiency, we as HERS raters, Home Energy Rating Systems, what it stands for, are actually an adjunct to the building departments. So we go through and do our inspections first, then hand that certificate to the building department who signs the final permit. So that's separate from the solar portion. So anything that does to do with the home energy efficiency actually comes through a HERS rater first. There's a separate form. Again, we sign off on that and say, yes, it passed all the different criteria then the building inspector can look at it and say, boom, the HERS rater's verified it, it's good to go.
Thank you. Terrence, could you proceed, please?
Sure. In terms of the next question, I think was related to getting a line of credit via RBC for the contracting team. That's not something we have pursued, and in particular, our contacts at Renewable, at Royal Bank of Canada are in the municipal market. They're not in a position to provide essentially private lines of credit for this. The next question was related to new construction versus retrofit. This program is a retrofit program. It's not for new construction. The next question I think was related to return on investment for homeowners. I think we kind of gave the whole idea of the loading order and the design of the program is to maximize that as much as possible. The next question was related to qualifying homes, and the first stage of qualifying someone for the program is ensuring that their home meets the financial test in terms of the 80% and the 2% tax and whatnot. And then once they meet that threshold, they're pre-qualified, and then they can go out and pursue the rest of the program once we ensure that the financial side of it has been completed.
So that's done by the property owner, not...
They apply to us, and it'll be done by Renewable Fund, and that's their process. Their responsibility is to pre-qualify the individuals. Then there was a question related to issues with quality of installation, and in particular example was the liability for a neighbor's trees and those sorts of issues. Our program is really a financing program, so when someone has a HERS rater come out or a contractor come out for a project and they see the trees, that's obviously something that will be taken into consideration when they're looking at doing a project. That's not something that obviously we've run into at this point since we don't have a program up and running, and it's not something that would be covered through our validation actions. We're just validating the financial and legal structure of the bond side. Can the county increase fees to recoup costs related to the program? That's obviously something that's up to the county. If you're looking to increase fees for building permits and those sorts of things, that's not something I can necessarily speak to.
Well, we just had an organization tell us they're going to get the $12,500.
Exactly. Then the next question related to the loan to value, and if someone participates and they qualify, they have something installed, and then 2 years later they sell the house and the market's tanking in for whatever reason, and now they're not meeting those requirements. When you're qualified, if you meet, it's not something that we're going to have a look back and say a new homeowner has to re-qualify for what's existing on their home. And I think that's all I had.
That's all I had. Thank you. Thank you. Are there any other questions or comments by the board? Les?
Yeah, I don't want to get into a philosophical debate with Supervisor Tryon this morning, but clearly that there are, like in any financial transaction, you have different ways to approach this, and each individual person that's considering this has to make their own decision. But the overwhelming value that I see in the program like this is that what the opportunity that it presents to somebody that is older like me, that is perhaps only looking to live in their house for another 5 years. It certainly provides a financing mechanism that you aren't obligated to pay that loan off out of the proceeds of the sale of your home, like you would be obligated to do if you went out to a bank and you took the loan to do the $20,000 worth of improvements to your home. So that's a very powerful component of this system to me. It almost like justifies the whole thing. It gives people an option that is not available to them in any other way. So, and no cost, no burden to them, no burden to the county, no burden to anybody. It's just it's like I don't know, providing a wheelchair that you can get from here to there. Who's going to criticize wheelchairs? So there you go.
actually have spent a lot of time thinking about energy issues. Our family looked at our future about 8 years ago, and taking a look at the stock market before it kind of crashed, we saw our return in our 401ks and our preparation for retirement as going along at a certain percent. Given the energy policies of this country and our state and what is available to us, we saw that going up at about double that rate. We took a calculation that given the cost of installing solar, as opposed to continuing to pay PG&E the rates that they were charging, that this would pay off in about 7 to 8 years. And given the life of the system, it would take 30 years, probably, at least that was the estimate we were getting, before it kind of ran out of steam. That meant that we had 23 years of advantage that was so much more than the stock market could have provided had it not crashed. But right now, for us, it's looking like the best decision we ever made. And it has paid off. It has, we're done. And we didn't have this program to help us in. So actually, we had to take it out of our retirement savings to be able to do this. But if it was right 7 or 8 years ago, if you take a look at what we have done in the last 7 or 8 years as a country to secure energy supplies in a diminishing supply of oil, if you take a look at the turn that we are making as a country to start taking responsibility for the fact that if everybody in this world used the amount of energy that we use as a people, as Americans, if that were the case, we would require at least 10 more globes, planets of this size, to be able to just sustain ourselves. Now, that's an equation. You don't have to be a rocket scientist, and you don't have to be a moralist to sort of figure out where this leads. And I do agree with Michelle that there are local benefits, and just if we just did it within our own little world of Calaveras, that there would be reason enough to go in this direction. It does create jobs. In fact, you can even tell that from the people who are in this room. But it can do a lot more if we're able to expand this. So it really does, it's good in and of itself locally. But I disagree with Michelle on this one thing, which is there are roles and responsibilities for us as individuals, as well as roles and responsibilities for government and the private sector that need to rise to the challenges that we're facing before we screw the planet up enough to make it a useless argument, to make it our points moot, and to waste what we should be as a generation passing on to a lot of people in the future. For me, this issue about government's role is very critical, and we have a lot of debate in this county about whether government should have any role in anything. And I can understand from our performance how one might come to that conclusion. However, government at its best, and if you look at things, just look at the history. Would we have any transportation system in this country whatsoever, which is, by the way, one of the things that is most important to our economy, some free flow of goods and services, some ability for people to move from place to place, follow opportunity. We wouldn't be able to get anywhere if it hadn't been for government, what's called government subsidies. The private sector developed the thing. But the government had a lot to do with research and development. The government had a lot to do with supporting fledgling businesses. Government was even bought by some of the railroads at one point, but so there's been kind of a lot of dynamics back and forth on this kind of thing. But what's government at its best? It takes moments where we recognize that there are climate changes, that there are things, whether it's caused by man or not, that there are things that we need to respond to, that our energy resources and fossil fuels are finite and ultimately will diminish. If we don't come to grips with that, then we're actually winding up with the fate of a Far Side cartoon that I've quoted a number of times, but it seems like a moment again. Far Side cartoon, Gary Larson, has a picture of a stegosaurus, at a podium addressing a whole herd of pterodactyls and brontosaurs and other Jurassic figures. Behind him are a bunch of charts, and every single one goes straight down. And the words are as follows. Well, folks, the picture's pretty bleak. The climate's changing, the mammals are taking over, and we've all got brains the size of a walnut. Now, that's a formula for extinction. We've got bigger brains, and my suggestion is, at a moment like this, with an opportunity like this, that we use.
Any other supervisors have anything I'd like to say? Okay. For myself, I, of course, was ready to ask the board to do a resolution of intent and conduct our public hearing, but as you've stated, it's too soon. So, I guess I'm going to be asking the board, is this something you'd be interested in pursuing when the window is open for us to participate? Because I need to be respectful of staff's time on this. So I'm just asking, I'm pulling the board. Supervisor Thomas.
I'd be a yes on that.
Mr. Telfanello.
Yes, madam.
Mr. Walensky.
Yes.
Mr. Tryon.
No.
And Ms. Callaway is a yes.
Once again, when we have a new government program, you can't differentiate between a Republican and a Democrat on the Board of Supervisors.
But the Libertarian does stand in.
That's why I'm no longer a Republican.
We want to thank you very much for taking your time and coming to Calaveras to explain this. If anyone decides to drop out of the 13, 14, or 11, I think you have board interest in that we would like to pursue this. And if you could please keep our Chief Administrative Officer informed, and everything would be funneled through her, we would appreciate that.
Yeah, absolutely. I appreciate the time you've given us today to speak about it, and we'll definitely keep you up to date as the program and rollout progresses.
And just as a bit of history, Mr. Sweet was very involved with Supervisor Suzanne Keel in getting septic system into the Vallecito area many in the 80s. So I'm assuming he will help us through this also. And
My
he knows-
family is resident of this wonderful district, so it's always a good time.
Okay. All right. Thank you. Thank you all very much for coming. And we're going to be moving into a closed session.